Hi everyone, if you can see me and you can hear me loud and clear, please type yes in the chat box right now. Okay, cool. Thanks Wei Ping, thanks Michelle, thanks Thomas. Okay, so I think everybody can hear me loud and clear. So welcome to today's monthly webinar at the 5th Person Hangout. And I've received many questions from you guys. I can see from right here. And I will try to answer, I try my best to answer every one of them. So what I need you to do is I will answer some questions from those pre-questions that's been sent to us. And in the meantime, if you have any questions, you also can type in the chat box. I'll do my best to answer most of them because I have a lot of questions. So I'll be very selective on the questions that can benefit everyone. Okay. Let's move on to the first one. Actually asked, I purchased Naratel shares at a cost of 0.7825. Currently, the value has dropped by more than 50% to about 37 cents due to of the recurring revenue business. So it will be great to hear your insight on this counter as you have written several articles on Naratel earlier. Okay, Naratel is one of the company that we used to own, and when we bought it is because of the recurring business, which is the payment solution. So after Naratel decided to sow away their payment solution business, we decided to clear off this company also. So we actually sold our position, and because the existing business is rather lumpy, and moreover the CEO also resigned from the company. So that's one thing that which caused us to, we sold our Naratel position. But luckily, throughout the years, we have been getting a lot of dividends, and of course, the investment is still profitable when we sold it. Okay, so let me move on to the next questions. Joseph, okay, Joseph asks, if the investment is sound, low PE, low PV, low debt level, positive macro picture of the company, etc., increase sustainable dividend over time, but the management is very conservative and the ROE is very low but always positive, does the investor stay with this company hoping for some turnaround to high ROEs or some days or divest or go for a higher ROE? Okay, basically I have two sets of rules when I want to sell a company. Okay, provided that the company I bought was a good company. So my two rule is, firstly, if the fundamental change, okay, that means there's some change in the business model or there's some disruption coming in, I will sell this company away. Secondly is, if the company is a bit too overvalued, I also will sell the company. So these are the two criteria that I look at. And looking at what you're saying, that I believe this is quite a good company. Why do you want to sell? Unless there's a better opportunity. Okay, the third criteria is there's a better opportunity out there. So looking at this, if you don't have better opportunity and the dividend is continuous increasing, on my personal point of view, I will continue holding. Okay, and Joseph also asked, if the investment is sound with all the similar characteristic, but because it's a smaller cap, investors are not keen on it, it's advisable to stay with the company as it continues doing decently but unloved by investor, and hence the valuation is never unlocked. Okay, so it depends on what type of company you invest. Personally, if the company you invest is operating business, that means every year they generate income, they generate earnings, okay, and the company is doing good and it's a small cap. Personally, I will continue to hold, because eventually this company will keep doing well and doing good, and the profit keep increasing. They will pay out more dividends, and as they keep paying more and more dividends, right, you attract more investors to come in. So I do not worry, and I can tell you a lot of the companies that did well for me are usually the smaller companies that people don't know about them. By the time people know about them, I sold the shares over to them. And the next thing I also want to warn you is that if you buy into, let's say, a small cap, but the company is an asset-based business. For instance, let's say the company has maybe 100 million in cash, then it's selling at 50 million, and you are waiting for people to come and realize the gain. Okay, that means the company do not have operating business. The operating business is not strong, but it's just that it's an asset-based company. Then probably I will not hold that long, because it will take very long time for people to even realize that company. So for instance, last time, let's say there's this company called Singapore Land, used to be delisted. Sorry, it was already delisted. And this company, right, for the longest time always traded below book value. And you are waiting for people to realize the value, and the company just pay very flat dividends and they don't increase the dividends. The operating business is a very small chunk of the big business. So personally, that type of company I don't usually hold, because I don't like to wait for people to realize it. I want to buy into operating business that they really keep making money and their profits keep growing and they keep paying more dividends. Eventually, people realize it. Okay. So let me see next one. So Grace asks, I would like to know if it's actually still worth investing in Facebook now, or with all the investigation going on. I do have a couple of thoughts, but what's your take on it? Should I let go or hold on? Okay. Personally, like I said, we don't give stock advice for this webinar. Is to clear all your doubts about things. But if you ask me about Facebook, I would think that the situation now is, do you think after this breach situation, right, people will stop using Facebook or not? Yes or no? I think the probability is that people will still be using Facebook. And if people will be still using Facebook, right, do you think that their business will go down? I think probably not. So I think personally, I feel that this is a temporary issue, and I don't feel any big impact on the company future. I don't think there's a fundamental change Facebook itself. Okay, so let me move on to the next one. So Stephanie asks, I have a question. What do you think about the outlook on the REITs? People say that the REITs may no longer be dividend making machine anymore. What's your view? Other than the interest rate hike, are there other threats to the REITs? Personally, I feel that REITs is always a dividend type of company, because as you know, they pay out 100%, close to 100% of their profits as dividends. Any threats, I think the only threats that probably REITs have, right, is as a whole, let's talk about the whole industry, not individual REITs, right? It's actually the interest rate. So I'm not so worried about interest rate. If you know how to choose the right REITs, right, actually interest rate won't affect you actually. So take note about it. Choose the right REITs so that the interest rate will not affect you. Okay, conservative investor. Okay, somebody's name is called conservative investor. He said that investing in the US stock incurs withholding tax of 30%. May I know how to claim back the tax being held by IRS? Okay, for my understanding about US, right, if you are Singaporean, you invest in the US, right, I only know from the Singaporean point of view is that the capital gain, there's no tax, but the dividend side, right, there's tax. So they got 30% tax on the dividend. This is one thing I know. Other than to claim back, I'm not so sure, because I'm mostly focused on the Asia market. But I do invest in the US, just one or two companies. But so far, what I see is that there's no capital gain, just that there's only dividend gain tax only. So take note about it. Cayenne asks, actually, when do I need to let go? I have some shares from IPO, but the price has dropped 50%. Dividend is still yielding at 3% at this moment, and I'm still harboring hopes it will recover from the share price point of view. Okay, every time when like I said, every time when I sell company, it must fulfill the three criteria. Firstly, does the company fundamental change, or the initial reason that you invest for the company, does it change already? If it change, you should sell. If the fundamental change, you should sell. Okay, if the valuation is overvalued, you should sell. Or if there's a better investment, you should sell. So these are the four criteria that I will see before I will do my decision. So you should ask yourself that the company that you bought, right, what's your initial criteria, as in initial thesis when you bought into the company? Is it still fulfilling or is it not? And do they have four of these criteria that I just mentioned? Okay. So Cayenne also asked, MREITs is pricing at a little volatile these days. Is it still a good investment? Personally, I think MREITs, right, is getting attractive right now. Okay, we have been tracking MREITs for quite a long time already, and every time when we go to the Malaysian market and look at the M-REITs, right? Rusmi and I was talking about it, and we were saying, how come the M-REITs, right, their yields are so little, but yet people are willing to pay the price, and their own EPS is their Malaysian EPF is about 6%. It's even better than investing in the M-REITs. But of course, a lot of my Malaysian friends say that they can't trust the Malaysian government. That's why they put their money more into the REITs. So we have not been looking at M-REITs for many years, but we're just tracking them, but we never really invest in them because the opportunity was not there. But recently, a lot of M-REITs stocks came down, and I think it presents a lot of opportunity, and that's the reason why we are more into the Malaysia market moving forward. Right now, it seems that there's a lot of correction in the Malaysia market, and also, as you know, Malaysia election is coming, and it may present more opportunity. I think Malaysia market there's more to look at it right now. So next question, Alan asks, what's the difference between a growth plan and a growth driver? How can you find out when a growth driver is no longer a driver? Okay. Firstly, what's the difference between growth plan and growth driver? A growth plan, give me an example of what's growth plan. A growth plan is the management tell you, say that I'm going to be grow my revenue to double up my revenue. I'm going to be $1 billion company. I'm going to go into this country. I'm going to go Thailand. I'm going to go Malaysia. I'm going to go Australia. I'm going to be a regional country. This is what we call growth plan. Okay, these are things that haven't happened yet, and you must know when a company expands from one country to another country, right, there's a lot of things, a lot of factors to take in, and it may or may not happen. Okay, but what is a growth driver? A growth driver is things that already happen. So I give you an example. So for instance, in 2006, right, when I look at Super Group, right, in 2006, their ingredient sales, right, which is one part of the new business segment, right, the management said they're going to grow this segment now, was only 1% of the total revenue, and the management said that this is going to be a fast-growing segment. And at the point of time, it's only 1% of the total revenue. So even it doubles to 2%, right, it doesn't even move the revenue. So I track until 2010. It becomes about 15+% of the total revenue. So if they double up to 30%, it will definitely move the revenue. And at the point of time, the quarterly report shows that the ingredient segment is still growing at 50%. So I know their growth driver had kicked in, and this is what I call growth driver. Back then in 2006, when Super announced this thing, that was a growth plan. It's not confirmed. I didn't go in. Okay, but I only go in 2010 because it's a growth driver. That means it's a confirmed case. So when do I know the growth driver is no longer a driver? Is in the end, I managed to sold off Super Group at quite high price before it tumbled it down. Why? Because when I track Super Group, right, when I bought into them, right, they have been expanding their capacity for the non-dairy creamer, which is their ingredient sales. Then after that, the management, if you read the annual report, they will say that at one of the quarter, the management said that they have stopped expanding because they have reached the supply had met the demand. And if you see the growth of the ingredient sales has been slowing down. So with all that said, right, I know that the growth segment is already gone already. So that's the reason why I sold Super. And luckily, we sold at quite a high price at that point of time. So that's how we see growth driver and growth plan. Okay. So one thing I want you to take note that you must know that a lot of listed company CEO out there, they will sell you a lot of dreams. They will tell you, I'm the next Coca-Cola, I'm the next Warren Buffett, I'm the next Amazon, I'm the next Facebook. Usually they are never the next. Okay. Every companies are very unique yourself. Warren Buffett is very unique. Amazon is very unique. There's no copy of each other. Okay. So don't believe in the management growth plan. You must know in Asian market, a lot of management will want to sell you dreams. Always track their growth driver, track their behavior. Okay. So remember to look into the behavior of the management. Don't always listen to what the management say. Always remember, well done is always better than well said. Okay. So let me see. So Alan also asked, some companies have few shareholders, say less than 500. What are the pros and cons of low numbers? Any specific areas you should look out for before buying such company? I think mostly if you want to say con is the liquidity thing, but usually I do not have any issue with such company, and I prefer to buy into illiquid company. Why? Because again, it goes back stock investment goes back to supply and demand. If there's more supply, right, you need a lot of demands to push up the share price. But if there's limited supply, you just a bit of demand, you can push up the share price. So a lot of times when the companies I buy, they are very low liquid. And eventually when people start to know that this is a good company, right, they start to be very liquid. So I'm not so worried about that. So just take note about it. Okay, so now I'm going to move on to, I'm going to answer some of the live question right now that is typing in. So give me a minute. Okay, where's the questions? Okay, let me have a sip first. Raymond asks, is there any tax on MREITs? I think locally, if you invest into Malaysia, I think there's a 10% tax on the MREITs, on the dividends. So Adeline asks, which online trading account will you recommend? Actually, I believe different trading accounts, different brokers have their own pros and cons. But if you want to get a lower cost in terms of buying your shares, you can look out for iFast now, which is up and coming. So you can go take a look at iFast if you want to save the cost on your brokerage. Let me see. Kenny asks, new investor here, what books will you recommend for us new investor to read? I'll recommend the Little Book of Value Investing. It's a green color, very small book like this. Okay, the Little Book of Value Investing. That will be a good book for beginners, I would say. Let me see, the question keep coming. Let me see, where's the question? Damien asks, do you do charting for support and resistance? No, I do not do charting for support and resistance. I purely fundamental. Okay, let me move back to the submitted question right now. Give me a minute. Okay, Zen asks about finding out the intrinsic value of the stock. Okay, you must based on the business model and find out the intrinsic value. Okay, you must know that a lot of times when people do investing, right, or they do valuing, right, but why people always lose money is because they use the wrong valuation method. They treat a stock like they're holding a hammer, but they treat every stock as a nail and they keep knocking it. That's not the way. Okay, different business model require different types of valuation. So for instance, let's say I give you an example. Let's say Raffles Medical. Okay, Raffles Medical is in the hospital business. Is it predictable? Yes, it's a predictable business because every year people will go to the hospital and they were sick. So it's a recurring business over there. So such recurring business and predictable business with strong moat, you can use a P ratio because P ratio is used for predictable business. So you want to plot out the P chart of the Raffles Medical, and you want to find out what's the average PE trading range for Raffles Medical. So that's how you find the intrinsic value of Raffles Medical. So let me move on. We actually asked, do you recommend trading options? I personally don't do any trading options. I don't trade any options, so I can't say whether it's good or bad because I've never done it before. Okay, but if you're a new investor, I think you should stay out of options trading because it's a bit complicated. But if you are okay with it, then you can go ahead. So David actually asked, how do you look for undervalued stocks? He says that looking at AK blog. So AK is one of our friend. He do writes about his investment and all this. You can look at his blog. He said, yep, we also get ideas from reading newspaper, reading The Age. Most of the time I get ideas through when I'm outside scuttlebutting or on the ground or any other countries. I will look at their product. I will see what are the companies that manufacture this product, or what are the companies behind this shop. Okay, and that's how I find my ideas. That's one way. Another way is I go it the very, very traditional way, which I screen the stock market and I read through every single company one by one. Okay, but I would say 80% of my time was going through screening a company and go through the company one by one. I go through the traditional, the hard way. So Philip asked about fund allocation timeline on a particular stocks. So if I would have, let's say he said $10,000, I spotted a fundamentally strong stock undervalued and currently at 10% discount to intrinsic value. Should I purchase in one go, or should I spread the purchase within within a timeline? Okay, so my take is sometimes you may think that the company is good, but you never know whether you will miss out certain details of the company. Let's say you want to set 10% allocation to that company, so that means you're going to invest in 10 stocks. If I were to do it, I will invest 5% only first. Then if the company that I bought drop another 10 to 20% down to the price I bought, I will initiate another 2%. Then if it continue to drop, I'll initiate another 2%. If it continue to drop from the latest price I bought, I'll initiate the last 1%, and I'll keep it at the maximum 10%. So that's how I usually do it. I don't one shot buy 10% into the company, unless you are very, very sure you already did all your homework. It's not. Most of the time, people are really, I would say, they are not really confident in the stock they buy. So let me see. So Junpang actually asked, what is the ideal portfolio diversification between income stocks and growth stocks? After a few scary experiences, I tend to be more focusing on income stocks due to lesser volatility, price nature, and stable dividend. But to attain financial freedom and just solely relying on contribution from income stock makes my dream of financial freedom quite far-fetched. Okay. Again, you should not think it that way. You should think in a way of your emotion. Okay. If you have very stable emotion and you can take volatility, then you should put a high percentage on the growth stocks and a lower percentage on the income stocks. But if you are the type of person who every time the share price drop 10%, your heart beat very fast, okay, then I would say that you should have very, very high percentage of your portfolio in income stocks and low percentage of portfolio in growth stocks. You have to balance it based on your your emotion, okay? If not, usually I'll tell people maybe you just do 50-50. That would be the most ideal split between these two type of companies. Okay, let me see. So HC Lee actually asked, every investor make mistake as we cannot predict the future. From your experience from the past investment, how would you advise being alert to investment make that sorry, that then go bad and due to new events and developments are likely to tank? Honestly, making losses is really part of the investing process. If somebody tell you say that they 100% make money, I think that person do not know what he's doing. Okay, there's no 100% or guaranteed make money in any investment. There's always risk in every investment, and sometimes you result in losses. And personally, myself, we also have been making losses too. Just that we set our allocation very standardized. So our win rate is about 70%. So out of 10 companies, 7 of them will make money and 3 of them will somehow lose money. But because we got more wins than losses, eventually the whole portfolio also make money. So that's what we usually do. And mistake, I think, is inevitable. Okay, until now, I'm still making mistakes. It's just that how you minimize the mistake. So every time you make a mistake on certain companies, you should jot down why that company didn't do well. But of course, jot the fundamental reason and why the company share price dropped. Not because of sentiments, but because of fundamental reasons. So the next time when you screen for companies, you make sure that the companies that you want to invest in do not have the same criteria. And that's how we always been doing it. We write down all the mistakes. And why our investing have eventually become consistent is because in the past we make a lot of mistakes. And from the mistake we learn and we create a checklist out so that we won't make the same mistake. It's all about learning from the mistake. Just like what Charlie Mangan said. Okay, tell me where I'm going to die, I will never go there. So learn from the mistake, then you learn from the winners. That's much better. So take note about it. So now I'm going to move on to the live questions right now. So give me a minute. You can type your live question right now. I'm going to answer some of the live questions. Let's see. So Jean actually asked, when will the dividend machine reopen next year, 2019? Someone asked, what is the realistic returns for Singapore stocks? Actually, the returns are very on. There's no fixed number to that, so I can't answer that question. So let me check for some questions. Paul asked, when starting a position, do you sell in one go or sell in tranches? It depends on the company. So let's say there's one scenario that this company is a good company, but because the share price is overvalued, right? But sometimes companies can run overvalued, can even be even more overvalued. So I'll probably sell whatever my initial investment first and leave the profit in. Then batch by batch, as it go up, percentage by percentage, I will keep selling. Okay. But if the company having some fundamental, let's say for instance, I'm holding into StarHub few years back. Example, I'm holding to StarHub few years back, and they announced there's a fourth telco coming in. They're going to increase competition, and StarHub valuation at also the peak valuation. At that point of time, I will sell the whole StarHub. I won't want to hold or take my time sell it off. I'll sell it quick. Okay. Let me see. Aaron asked, what's your viewpoint on cryptocurrency? I think cryptocurrency is a bubble. There's no asset back behind it. There's no cash flow generation. That's why you don't see I'm inside cryptocurrency. Let me see. Okay. Let me see what the question. Darren asked, do you set stop loss to your investment? No, I don't set any stop loss to my investment. I purely based on fundamentals. Sankan asked, actually, what's your viewpoint of putting all your money in STI index because it's diversified? You can put your money into ETF, index ETF. These are I would say that index investing, right, is for those people who are too lazy to do research. You still can put out there, but you must know that you must hold for a long run. You cannot buy index stocks and you expect you very fast make money. You must hold it for a long term. Okay, index in the long run generally makes money, except for the Japan index. Other than that, most index makes money in the long run. So just think about it. Okay. Joe asks, when do you think that the oil and gas will bottom? Personally, I do not know. I do not know when, you know, the cycle of the oil and gas will start turning back again or bottom, because I really can't predict it. And most of the time, I really don't do this type of things. So my job is to just focus on the fundamental of companies. I make sure when I bought into a company, my risks are protected, and I will take care about itself. So Florence asks that do you generally avoid hospitality REITs because of their cyclical nature? No, I won't avoid hospitality REITs. Just take note that not all REITs you can buy and hold for a long term one. Some REITs like hospitality REITs or office REITs, like they goes in cycles. So you have to in and out all this. So when they are down, you buy. When everybody start to realize that the office REITs or the hospitality REITs are good, then you sell to them. So we have in and out office REITs for quite some time. Hospitality REITs, to date we have not bought it because it doesn't show any good valuation for us to even buy into them. Okay, keep your question coming. I'm going to move on to the pre-submit questions again. Give me a minute. Let me have a sip first. Okay, what's the other pre-submit questions? So Dylan actually asks, what does EV/EBITDA aims to evaluate? Okay, I think EV/EBITDA is used for companies where they have very high depreciation. Okay, which means that the company's earnings are being distorted. Then you use EV/EBITDA to do the valuation. So Dylan also asks, what's the difference between diluted EPS and EPS? Which one should you look at? Okay, diluted EPS is that, for instance, let's say the company got 100 million shares, but they got about maybe, let's say another 100 warrants which haven't been exercised. So diluted EPS accounts the 100 million shares and the 100 million warrants that haven't been exercised. They assume that the warrants are being exercised already. And the normal EPS just took the 100 million, that's all only. So if you want to be very conservative, right, you use the diluted EPS. So depend on how conservative you want to be. Okay, Dylan also asked, what is cash flow to earnings ratio? How much is a good indicator? As long as the cash flow is always more than the earnings, which I think give you a one time, if I'm not wrong, it means that the earnings quality is good. So the cash flow must always be more than the earnings. That means it gives you a good earning quality. You don't want to have cash flow less than the earnings. That means a lot of their money are stuck in the receivables. So take note about it. So Vince actually asks, which will you choose now? Buy a stock that's the Warren Buffett way, with mode, no debt, margin of safety, decent, good growth over a long term and mid term, great ROE, call it company A. Or buy company B, a stock that is heavily beaten down, example 1 year or 10-year low with no mode but thick in assets, no special competitive advantage, but might experience a quicker rebound or better returns in the short term. Personally, I would choose company A, because as you say company B is just an asset company. You have to wait for people to realize it. What if people don't realize it? I usually don't take that type of risk. So my take is I will take company A. Let me see. Let me move on to another questions. Grace actually asks, how can a company increase its share? Through rights issue, use new shares to pay acquisition bonus share. So what would be the impact? Rights issue, if you are the existing shareholder, right, they usually give the rights to you. And if you subscribe, there's no dilution. If you never subscribe, there's a dilution. And usually when issue of bonus shares, there is no dilution, so don't worry about it. Is there a limit for a company to issue new shares? It sounds like QE. Okay, I do not know whether there's a limit or not, but usually when the management to issue new shares, right, the management itself will give a limit. So that's one thing I know. So you have to read the company every time when they issue a thing, they will tell you how much and they're going to issue. They won't issue that. So far, I never see people issue a lot of shares at this moment. So Grace also asked, can the company reduce its number of shares? What is share cancellation? Share cancellation basically is the company buy back the shares, and after that they cancel this, they cancel the share off the market. But in Singapore, usually what happens is that when you buy back the share, you can keep it under treasury share. Next time you can take that shares is worth value and you can take that and sell back out. But in Hong Kong market, it's a bit different. When they buy back the share are immediately being cancelled off. So that's share cancellation. So why does the company want to reduce the number of shares? What is the impact of the action on the shareholder? If the management buy back the share at the correct price, it will benefit the existing shareholder a lot. But if the management buy back the share at an expensive price, then it will really harm the shareholder. So it boils down to what's the price the management is paying when they're buying back the share. That's the important thing. So think about it. Let's see. Karina actually asked, how do you find multi-baggers? What kind of characteristic do you look for? Usually what I realize about multi-bagger is they are very small niche players, and they usually have a very, very long runway in terms of their growth. So they are usually in industry where, not say in, that means, how say, their growth driver is a very, very long runway. Let's say the company is in one country, but this company able to scale their business outside of their country. Then that I would say is a possible multi-bagger. But most of the companies, especially Asia, they only stay within their own country. Yes, they will become multi-bagger, but just for maybe a few years, but they won't be for many years. So one thing you want to see is the runway of the business. Unless you tell me the company is just very small in the country and you're going to expand throughout the whole country very fast, then it will become a multi-bagger. And usually I would say look for niche player with actually they are a very niche player in their own category. Actually they own dominant market share already. So look for that type of people. They are usually multi-baggers. And I would say it's not easy to find. You really have to search. I searched it many times and I only can find a few. It requires a lot of works to do that. So take a note about it. Let me see. How do you maintain the conviction not to sell your shares? Say it goes up 5 times or 10 times. Which is asked by Karina. So it also boils down to the company again. Do you think that the company have long runway? If you think that at this price, even though the company is overvalued, right, you want to ride through with the management. So I'll give you an example. There's this company, right, listed in the Thailand Stock Exchange. It's called Bumrungat International. It's a hospital business listed in Thailand Stock Exchange. And this company, right, if you're invested in 1997, right, and you hold it 20 years later, right, every $10,000 you invest, it becomes 1.3 million. And if what I'm trying to say is that you must ride through with the business. If you have sold the company along the way, right, because you felt that it's overvalued, right, and you never hold it for that 20 years, right, you won't hit your 1.3 million. So my take is, I come to understand is that every time I bought into a good company, very strong company with very strong moat, I will do my best to hold it as long as possible. Even though it went up 5 times, 10 times, I will just hold it. Okay, unless you tell me the valuation is super, super expensive, then I'll probably sell off maybe my initial my initial investment and take back first. So I leave my profit inside. Then I slowly clear it off tranches again. Okay, that's the only reason that I will sell. So let me see. What's the other question? For Kathy actually asked, for dividend given by companies from overseas stock exchange, the check, example ringgit, cannot be banked in Singapore. What can be done? I received US dollar check before and I still can bank it into Singapore. I'm not so sure why you can't bank in. This one, I think you may have to ask your bank. So Chng actually asked, for investing REITs, most dividend are taxable. Actually, the REITs are tax-free, so don't worry about it. There's no tax. Then Chng asked, are there capital gain or dividend capital gain or dividend from investing overseas like US and Hong Kong taxable? Like I said, US and Hong Kong, there's no capital gain tax. Hong Kong also do not have dividend gain tax also. US have a 30% dividend tax. What do you look for in the market like US? What do I look for? Look for undervalued stock. This is quite general. I don't know how to answer this question. I will look for undervalued companies if I can. But of course, the US market is not cheap right now. That's why you don't see I'm in the US market. But when the US market is cheap, you'll see I will be busy looking at the US market. Let me see. What are the other questions? Okay, I'll answer some of the live questions right now. Let me come back to the live questions. Okay. Jean asked, what do you think about Fund Supermart? Do you personally use Fund Supermart? We don't use Fund Supermart, but we are the shareholder of iFast, which is the owner of Fund Supermart. So Kate actually asked, how do you determine if the margin of safety is good enough? 10%, 20%, 30%? So it also boils down to the type of company you're investing. If I'm investing in a strong business model with a strong moat, this type of company, right, usually I buy from zero margin, right, all the way to 30%. I will buy them within this margin. But if the company I think is a fair company, not so good, I'll try to buy at 50% margin or more. So that's my target usually. Florence asks, what do you think about Tencent Holding? Do you consider this a multi-bagger? Tencent Holding is definitely a multi-bagger. If you have bought since the day one until now, I think it went up 500 times. Tencent is a superb business. A few years back, I've been to Guangzhou, and when I was at the counter, I paid by cash. I feel a bit inferior because everybody is paying by WeChat. So the country, if you go to China right now, a lot of people still think that China is still very country punking. Okay, it's no more. Okay, China is very advanced right now, and when I go over to China, I take a look. I'm very surprised with the technology that they are using. And Tencent is the one that is in the China market. And if you look at Tencent, they have been growing at 50% revenue growth every single year since the day they are listed. So there's still a lot of room to grow for Tencent. It's just that you have to pay at the right price to buy them. Okay, let me see. So Elvis actually asked, what is NT? Net tangible assets, which means that it's the same as net asset value, just that you minus off all those intangible assets like goodwill. Yeah, all those intangible, mostly is goodwill. You minus off those intangible assets and goodwill. Okay, let me see. Keep your question coming. So Handy actually asked, how often do you conduct this kind of Q&A webinar. We do it every single month. Okay, sometimes it's we share certain knowledge. Most of the time it will be a Q&A webinar. So tune in our email so that you know, keep yourself updated for the webinar. Jennifer asks, as a layman, I read that the STI has been on a high since the start of 2018. Would that mean that the most stocks are overvalued right now? I won't say STI is at a high. I'll say the Hong Kong and the Singapore index are generally at a fair value, whereas the other regions are slightly above fair value. I would say that I won't say that most stocks are overvalued right now. There's still opportunity out there. Like I told you, Malaysia market there's an opportunity. It's just that maybe at this current time, right, in the normal crisis situation time, right, maybe out of 10 companies you look at, right, maybe 7 of them is you can find good company. 7 of them is undervalued. But right now at this era, maybe out of 10 companies you look at, right, only 4 of them is undervalued. So you just need to do more work to find more ideas. That's all. Okay, it's generally harder to find at this moment. Kate asks, what is net stocks? Is it good to buy and hold for long term? Okay, net stocks are companies where they are selling below their let's say the company value is 100 million, but they're selling below their value. That means their assets value is about 100 million. They're selling maybe less than the 100 million, less than their 100 million asset value. Okay, these are usually I would say fair companies. They are not very good companies. Sometimes they are very lousy companies with very lousy management. So net stock is not something you buy and hold long term. You buy, and when it hits the value, you just sell. You just keep rotating. So a lot of work to do also. So Yao King actually asked, do you consider Berkshire Hathaway B share as a good alternative index since it consistently outperformed the S&P? Of course, I think it's an alternative to the S&P 500 index. So Paul asks, what do you consider cheap for the US market? What level of PE for the US market for S&P 500? I think the S&P 500, right, their fair value is about 15 times. So right now we are traded around the 21 time region. So it's slightly above the fair value. Actually, I would say it's the overvalued region. Haven't hit the bubble region. Their bubble region is about slightly above 25 times. So if you tell me what the cheap is 10 times and below, that will be a very cheap market. Kuneng actually asks, when will we expect the Wealth Hacker t-shirt, or the one that I'm wearing right now? I'm from Malaysia. I believe you say that because you subscribe to Alpha Lab. If you subscribe to Alpha Lab, one of our partner Chng will be sending it out soon. So you should wait for it if you are subscribed to it. Let me see. Will Adeline ask, will the identification of undervalued stock be taught during the dividend machine course? Yes, during the dividend machine, we will teach you how to a way to value dividend companies, and you know when it's overvalued and when it's undervalued. Okay, let me see. What keep your question coming. Jean asks, can we still subscribe to Alpha Lab? Yes, you still can subscribe to Alpha Lab. Before the Sally actually said, before the quarterly release of the annual report, if increased profit reported, normally push up the share price. So you buy before the release of the result, or you sell later for a quick profit. Actually, we don't do that, so I can't advise you that much. But I think the way you're doing this, right, over a long term, right, you may lose money. So be careful to not 100% follow this method, I would say. So Darren asks, what percentage of risk do you think a portfolio of stock for regular income dividend payout should contain? That means, if I get your question correctly, that means you ask how many percent of your portfolio should be REITs, right? I would say that maximum should be 30% or maybe 40%. Don't go that. Don't over reliant on the REITs also. Just take note about it. Handy asks which brokerage you are using. I'm using CIMB, I'm using Chng also. So these two are the brokerage I use. Okay, Vincent actually asked, according to QAF annual report 2017, the oversupply of pork is cyclical factor affecting the entire business industry. With that in mind, do you consider QAF to be resilient? So it boils down to what business is QAF in. QAF is also in the gardenia business. So you must go and find out, right, how many percentage is the bread business, because bread business that they are in are usually recurring in nature. So you must go check what's the percentage. If you tell me it's more than 50%, maybe it's resilient in nature. Okay. Okay, let me see. What are the color? Someone asked, what's the difference between rights and warrants issued by the company? Rights and warrants actually is the same mechanism, just that the rights, right, happens only within 2 weeks to, you must exercise the rights between 2 weeks to 1 month. Okay, for warrants, right, you can exercise within a 3 years period, anytime within a 3 years period. So it's a longer period. Okay, Jennifer actually said, I'm a very newbie at investment. My knowledge is close to zero. I'm going to dividend machine next week. Last week, my insurance agent told me that he will recommend me invest in funds instead, where I let the fund manager manage the portfolio. While I'm lacking the confidence in personally and actively investing, I do think that I should at least pick some knowledge of value investing, but it sounds like there is so much to learn and know, even as basic as understanding the fundamental of the business. Where can I find such information? My first concern is, how do I choose which stock or REITs to look out for and track? I hope next week course will be an eye-opener for me. Jennifer, I'll say that if you just come for the course, we will teach you how to look for income stocks and REITs. So don't worry about that. The next is your insurance broker. You must know, every time when the insurance broker, right, when they sell you funds, right, they also get a commission from it. So be very careful when people recommend you things. And moreover, I can tell you, a lot of the mutual funds, right, don't make money because of the management fee are very high, 2%, 3%. If you do that in the long run, right, you actually lose money in the long run. So if you really want to invest in fund, I would rather you invest in index, ETF. Okay, you can invest in the STI index, the Hong Kong. You must spread your funds between the STI index, Hong Kong index, the US index, or maybe the not Japan, maybe the China index or Malaysia index. All these index you spread evenly among all of them, but you must hold it for a long term. I think you will perform even better than those fund manager in the mutual fund, because their management fee are way too high. Okay, I can guarantee you in the long run, you definitely lose money on. So do it yourself. You'll be much better. You'll be much better than you put in the fund manager. Okay, unless you tell me the fund manager that you put in is a value fund manager. There's a lot of value fund manager in Singapore, so you can go take a look at them. They perform quite well and their fees are quite low as compared to all those mutual funds. So take note about it. Adeline say, what do you think about getting ETF through banks? I think you should just get it through your broker, because you get it through your bank, you still have to pay the fee to your bank, and you also pay the bank will help you to buy through them using a broker, then they also have to pay a fee. So that's a double cost already. Buy it yourself, buy it through your broker. Jaslyn said that I recently attended the M1 AGM 2017 and disappointed on the board response. How's your view? I'm also there. I'm also very disappointed. Basically, I think M1, The management didn't really articulate how they want to grow money. Everything's are quite general. Personally, I also have quite bearish opinion about M1 moving forward. I think the fourth telco coming will definitely hurt them. Sally asks, how do you invest gold in your CPF account? When you log into your CPF account, there's a limit under, I think, your statement. There's a limit down there. You can know how much you can invest. But my take is, if you invest your CPF money into gold, it's very, very risky. I'd rather you transfer your money back to the SA account, your special account, which give you guaranteed 4%. It's much safer than you put in the gold. Okay. So if you must always have this thinking, if I want to invest outside of my CPF, right, I must make sure it must beat 4%. Because if the investment that I invest cannot beat 4%, then I think you may as well put your money into the special account, because the special account can give you guaranteed 4%. You only invest your CPF outside to other place, right? It's only when you can beat the 4%. If you cannot, right, put it into your special account. It's much more safer. So Aaron actually asked, regarding mutual funds, will it make a difference if they have access to the funds which normal retail investor don't get access to, or still lose money for sure due to high management fee? Well, every time when you look for a fund manager to invest, right, you must look for two criteria. Okay, first criteria is the track record of the management. Do they have track record? Second criteria is that the fund management fee must not be high. Okay, then I tell you, if you invest in such management, right, and the fund management not high, in the long run you make money. But if you invest in a management who have usually companies, how to say, usually company fund management with high management fee, they do not have a very good track record. I haven't seen one with that yet. Only maybe out of 10, there's only one that is there, but it's very few. I haven't seen so far yet. So I think management fee will determine, right, whether you make money in the stock market. But of course, you must make sure there's track record. Okay. Handy asks, do you use leverage in your investment? No, we don't use leverage. Should we even invest in SSB in our portfolio? Claire actually asked, which is Singapore bonds. Yes, you can if you want it to be buffer. Okay, if you know that if your SSB is higher interest than your bank, then you want to put some into as a buffer to, you don't want to be totally in the stocks. Yes, you can have some SSB inside. Jaslyn asked, can we attend company's AGM if we are not shareholder? No, you cannot. You have to be shareholder to attend. Jennifer asked, what is considered a high management fee? I would say anything more than 2%. Okay. Generally, I think the normal management fee 1% is still okay. 1% and less is still okay. 1.5 maybe still okay also. But anything more than that, I think is too high already. Okay. You must know, when you never make money, right, when the share price all crash, right, the value go down, right, the fund manager are still getting the management fee from you, So imagine when your funds are down and still getting a lot of management fee from you, then when you want to rebound back, it takes a long time, because when you are down, they are taking money off the funds. So think about it. David actually asked, do you time your entry when buying stocks? No. If I see there's value, I'll just buy it. Kuning actually asks, US stocks and SG markets index has been up and up for the 6-7 years consecutively. Do you think that it will burst? I cannot predict the market. I do not know. But what I know is that our look at the valuation of the market. If it gets too much, right, then you'll see my, as in you'll get, if it get too high, right, you'll see my cash position, right, will swell even more. Okay, but if the market is very cheap, right, you'll see my cash position going down. So that's how I usually do it. But I will not be totally out of the market because no one can time the market. Even Warren Buffett can't time the market. So think about it. Darren asked, what percentage of the portfolio do you think should keep, as cash as this time of the market? If I start investing right now, I'll keep 50% cash. Okay. Elaine actually asked, how do you see there's a value for a stock? Basically, you must know how to value the company. So if you value the company at, let's say, $1, okay, conservatively you value it at $1, and the company is traded at maybe 70 cents. Is it undervalued? It's undervalued because it's traded below the conservative value that you just calculated out. So that's how we usually do it. Sally asks, where do you park your CPF funds safely before CPF wipe out for your BTO flat payment? Okay, this is very, very tricky because you have to buy into a very, very stable, I would say, income stocks, and you must buy it at the correct value. My take is, if you can't find any stocks that you can buy it at a good value, right, try not to take out your CPF fund, because I tell you, it'll be very painful if you are forced to buy a stock for the sake of just shifting out your CPF money, and after that, let's say the stock tanked by 50%, you'll regret bringing out your money. So make sure that every time when you want to invest your money out from the CPF, right, make sure that the company is really cheap, undervalued, pay good dividends, then you invest. Okay, then you know that your CPF money is well utilized. Okay, don't bring out the fund for the sake of bringing out. So just take note about it. Okay, so my take is that CPF, right, is your hard-earned money. Okay, it's everybody's hard-earned money. Okay, that CPF is equivalent to Malaysia EPFs. Just in case there's some Malaysia audience, only invest it during crisis, because during crisis, right, you can get you more than 4% definitely, and you can buy companies at very cheap price. So basically, it makes more sense to invest your CPF money during crisis than normal time. So take note about it. Okay, don't be too eager to invest your CPF money. It's your hard-earned money. Don't anyhow take out and just invest. Be very prudent in allocating your CPF money, and make sure every time you allocate, right, you will make money. You see, I learned this from my dad, because my dad, right, he listened to a lot of insurance agents to buy funds, buy mutual funds. He invested about 100 over thousands in a lot of all these funds and all this, and by the time when he can redeem everything, right, or the stocks that a lot of the insurance people recommend him, right, when I cleared his portfolio, he only got back about 20,000 plus. He wiped out a lot of money, 80 over thousands. Okay, because my dad don't know what is he investing, right? So I don't want you to be in the same position my dad. Okay, and that was when my dad was very young, because I was still not doing investing. But if my dad asked me right now, I'll tell him, I'd rather you put in the SA account. You don't go touch it. Okay, my dad regretted investing out without knowing what he's doing. So, but if my dad invested during crisis, right, any stocks, right, or I won't say any stocks, maybe all the blue chip stocks, right, he'll definitely make money somewhere one. Okay, because in crisis everything is cheap. So take note about it. You only take your CPF money, right, when the chances of you making money is very high. Then you take it out. If not, don't. I would say don't touch your CPF money. Okay, it's really your hard-earned money. Okay, for your retirement. Jennifer asks, can we use CPF for value investing? Yes, you can do it, but make sure that you are savvy to do it. Never use CPF to buy REITs, because REITs, sometimes they have to call for rights issue. So if you don't have enough funds to buy the rights, you'll get diluted. And if you want to buy, you have to top up your CPF. So take note about this. Okay, it's about, oh, it's just hit an hour already. We are almost there to the end of this webinar. So I'll answer maybe a last one or two questions, and that's all for today. So keep your question coming. I'll try to answer another one or two questions. Let me see any question. Sally asks, when do you estimate the next crisis coming? I can't predict the future, seriously. If somebody tells you that they can predict the future, something wrong with that person. Okay. I cannot predict the future. I really don't know when the crisis comes. But what I know is I know how to do things to protect from the crisis. That's all. Elaine asks, if you need to pay for housing bank loans using CPF, is it better to use cash or pay instead? Use cash to pay instead. I mean, if can, because CPF is your money, you don't really touch it, you cannot use it. So I think use CPF to pay for house is much better than using your own cash to pay for it. That's what I will do for myself. Okay, I'm going to answer one last question. Kenny asks, should I start investing as a uni student with low income? My take is you should start off saving money first. Build up your capital. Okay, and at this point of time when you're building up capital, learn how to invest first. You don't want to invest straight away in the stock market, but you don't know what you're investing. So build up your knowledge and save up your capital while you are still in the university. So once if the stock market crash, you can activate faster. Okay. So I hope I answer your question. So it's already been more than an hour. I hope you learned a lot from today's session, and you can take back to to review yourself also. So if not, I'll see you at next month session. So thank you so much. So if you love what we are doing, just spread to people out there and telling people what is fifth person doing. So thank you so much, and I will see you in the next webinar.